The Moving Iron Podcast is brought to you by these great sponsors. Are you looking to value your equipment more accurately, target the right buyers and close more deals, reach your ideal customer? Then look no further. Fusable isn't just about ag data, it's about action. Our best-in-class solution empowers you to value your equipment accurately, make informed decisions, and find the perfect prospects. Ignite your dealership's growth at fusable.com/movingiron-podcast. Out in the field, every decision counts. You wouldn't plant without testing your soil, so why would you prospect blind? Introducing EDA, your one-stop shop for ag equipment intel. EDA goes beyond specs and prices. You get deep dive data on every piece of equipment like UCC filings that help track ownership changes and uncover potential sales leads. D&B firmographics, which help you understand the financial health and buying power of potential customers. Market trends that help you stay ahead of the curve, and insights on equipment demands and pricings. With EDA, you're not just looking at data, you're seeing opportunity. Find the right buyer, sell smarter, and build lasting relationships. Visit edadata.com for your free demo and unlock the power of knowledge. For over 80 years, Iron Solutions has been your go-to data source for ag dealers, lenders, and manufacturers. Get powerful appraisal and value forecasting tools that fuel profitable decisions anytime, anywhere. Get your free demo at ironsolutions.com. Iron Solutions, confidence in every click. Today, there are many ways to finance ag equipment, but nobody delivers simple, fast, or flexible financing like AgDirect. Learn more about your options to buy, lease, and refinance equipment at agdirect.com. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours.
When you partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
At Big Iron Auctions, customer satisfaction is our #1 goal. As the 40-year leader in auctions for agriculture, real estate, livestock, construction, and transportation, we are here to serve you. Big Iron will handle everything from start to finish. From meeting with you, to prepping your equipment, writing the listings, and collecting buyer's payments, let us do the heavy lifting for you. We love our customers, and we treat them like family. There's a Big Iron sales rep in your area, so let's get together. To learn more, visit bigiron.com.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here. Moving iron.
Hello and welcome to Moving Iron Podcast Markets with Shawn Hackett. Shawn Hackett is with Hackett Financial out of Boca Raton, Florida. He's nice enough to come on and talk about what's going on in the world of commodities. Shawn, how you doing?
I'm doing good. Really, really good. I'm getting ready to go back out on the road later this week to Iowa and such. So we're spending a lot of time on the road here in the next 3 or 4 months. So
Yes, this is the speaking circuit time of the year for ag. Between now and basically March, you kind of have that's your stretch when there's not a lot going on in the field and those kind of things. So
yes.
a lot of stuff moving there.
But I'll be on market to market on Friday,
Right.
and then I'll be in South Dakota here in early December. Some farm credit service meetings, and the beat goes on. So
Right on. Well, there's a lot of stuff to talk about. We won't have any lack of things to talk about. You had you down at the Moving Iron Summit here last week, and you had great turnouts to your sessions and got good reviews for everything you're doing. So if you're looking to hire Shawn to be a speaker, I can't say enough good things about him coming in, and the interaction with the crowd will be next level, because he's going to talk about stuff I'm sure the majority of the people in the crowd haven't heard before. So it's always interesting talk. So Shawn, safe travels as you go where you're going. So we'll catch up with you when you get back. But yesterday you put out one of your reports, and if you're not a subscriber to Shawn's stuff, you really should be, because there's some good stuff there that hasn't that you don't hear other places, right? One of the things I was been watching the markets, right, and everything's been doing really good. You've got corn's been doing well, soybeans are doing well. I mean, cattle for the most part's been doing well. There's a little struggle there a little bit, but the one thing I couldn't get my head wrapped around is why is wheat not rallying like everything else is? And you had a little 2 or 3 sentences in there where you're talking about you had the Russia-Ukraine war. Trump's vowed to end that, and the market has already cooked it in. I guess basically cooked it into the thing that, hey, when the war ends, we're going to be back to gumdrops and candy canes again as far as wheat production goes, and in the Black Sea region. Which, if you take a look at where that's at, a lot of their grain facilities have been attacked along the Black Sea regions. Grain facilities inland have been attacked too. So it's not like they can go out and produce a crop and do all the stuff they're going to do, but the infrastructure has taken a big hit. So I guess, Shawn, as you're looking at this short term, what do you see? And then in your best estimate, as you look at this long term, when do you think Ukrainian wheat production and grain production in general could come back on line as far as we would see before the Russia-Ukraine war, if it stopped today?
If there was an agreement and there was a strong sense of surety that it was going to create a longer standing period of peace, and that capital felt comfortable coming back in, because if you come back in and build a grain bin and they go blow it up, that's not really a good return on your capital. So if all that happens and there seems to be a new normal that the capital feels comfortable coming in, I would say that you would be looking. So let's just, my feeling is he's going to get on January 20th. I believe he probably, if he's successful, probably could work something out on an agreement sometime, I would think, in the spring. I think they could come to an agreement about a new set of rules. Some territories that were Russian, they get to keep, whatever they decide, how they would decide to do it. I think the spring is when they could probably set something up. At that point, what I believe the market will want to see is, okay, does this, what happens the next 3 months? Does everybody play fair? Is everybody abiding by the agreement? Is there any rumblings under the surface? So I don't really think capital would come in to the market or start coming back in, investment coming back into Ukraine until the fall of 2025. Once it starts coming in, I don't really think that you would see a material change in their production potential until the summer of 2027. You would see some increase in 2026, but I think the gap up in production that maybe starts to bring their production back to where it was. I don't think you'd be thinking about that. This is, of course, assuming good weather, until the summer of 2027. Remember, this coming crop season, the die has been cast. The winter wheat crop's been planted or not planted. The weather's been good, it's been bad. The die's been cast for the winter wheat production for next year already. There's nothing that can happen to change that. Yep. The weather's been terrible. They had a terrible planting season. So they're not going to have a good winter wheat crop in 2025 in Ukraine. There's nothing that can be done about it. And there's really nothing that can be done to produce much more corn. There's not going to be enough time to put money in to really change that. So I don't see any settlement of a war or an agreement of the Russia-Ukraine war impacting production in 2025 at all. I think it could impact production to some extent in 2026 and substantially in 2027. weather being good. So the way I'm looking at, the wheat market is obviously, we're not really worried too much about 2 or 3 years ahead at the moment. We're trying to figure out what's going to happen over the next 6 to 12 months. I think the situation really, so the reaction we've gotten, I think your question is saying the reaction we've gotten negatively to the market to a settlement of war is extremely premature. We still have to trade the current fundamentals and the forward fundamentals. The forward fundamentals are this. Russia's crop this past season was 82 million metric tons, down from 104 from a few years ago. They've had one of the worst planting seasons in 50 years. Their production, if they're lucky, will be equivalent to what we just saw at 82 million metric tons, and most likely will be under 80 million metric tons. They've raised export taxes. They're pulling back on exports. Their wheat stocks right now are down to 38 million metric tons from 48 million metric tons at the same time a year ago, meaning they're destocking because of the smaller crop and the aggressive exports they've had up to the point that they've raised these export taxes. Russia, the Ukraine wheat crop was terrible. The European wheat crop was terrible. The U.S. wheat crop was phenomenal. Those are the fundamentals we have, Casey, and the stocks to usage ratio in exporter hands is at a decade low. That's the fundamental picture going into 2025. And remember, if Russia has another crop of 82 million metric tons or less, their exports are going to fall even further. Our best guess right now is their exports for this marketing season will be 45 million metric tons, down from 55. And we think they could be under 40 million the following year. And if there's weather problems in the spring with another potential for frost, which we think is very, very high in Russia-Ukraine this coming season, we could be looking at even worse situations. So when I look at that, it makes absolutely no sense whatsoever that the market would be discounting a war settlement now. It makes no sense to me that they would be at 560 SRW wheat price. There is no geopolitical premium. There's zero. There was no geopolitical premium at 580, in my opinion. So I think it's an irrational trade, but I understand, right? That's what speculators do. They speculate and they move money around and they trade things. But I think ultimately it's a huge false flag. We call these things false flags when a market falls on a piece of news that really has absolutely positively no material impact to the fundamentals for the foreseeable future. And I mean by the foreseeable future, I mean the next, let's say, 6 to 12 to 18 months. It's not going to impact the fundamentals whatsoever. That's an opportunity for physical buyers in the marketplace to take advantage of this discount that we've seen in the marketplace, really pre-election, because the market had already sensed that Trump was likely going to win. It's just an opportunity to take advantage of that. And so to me, that's where I think we're at right now, and why I think that trade, although I understand the psychology of it, that trade is just way, way too early in having any validity at this moment in time.
Yep. Yep. When you take a look at corn and soybeans, for example, they've been on a tear since the election. The USDA report came out on Thursday last week, and we talked about that, or for the Friday. It was Friday, I think. We talked about that, and how that looked, and what that meant. Very favorable, I guess, if you looked at it from the perspective of where the trade thought things were going to be and where things came in at. As you continue to watch this corn and soybean market, how much longer do you feel like this rally that we're seeing right now is going to last? And then, secondly, do you still feel like that $4.50 to $5 range for corn is a very achievable number as we head into the marketing season here post harvest?
Corn is a classic demand-driven market right now. Demand is just exploding. The USDA balance sheet does not correctly ascertain the correct demand yet. It's still too low. And yet we're still under now. Remember, we started at 2.3 billion bushel carryout. Then we went to 2.2, 2.12. Now we're 1.9 and change. We're going to wind up being at 1.7, 1.8 billion bushel carryout when the correct demand is assessed correctly, when they finally get around to figuring all that out, either through a combination of increasing demand or finding out that our actual correlated grain stocks aren't there, like they magically always find later on. We just can't find the corn we thought was there. And remember, Brazil's crop last year was very poor. Their exports are way down. We know that the Russia-Ukraine corn crop was terrible. We know that the EU corn crop was terrible. The U.S. corn crop was good, very, very good. So we have a lot to sell, and we're selling it. But I don't believe farmers are going to sell at these price levels forever. They're going to sell what they need to, and then they're going to lock it up in the bin. They typically should start to do that. Remember, we had a very, very fast harvest, almost record-setting fast harvest, which means extra hedging pressure earlier than we would normally see. And so I think we're getting pretty close to where the farmer has gotten his balance sheet where he needs to. I think it's going to be hard to find him a willing seller until we move into more in that $4.50 to $5 area that I think is very achievable, especially if it looks like Brazil's going to have another challenging second crop corn, which we think it will, meaning we don't think that the crop can be a whole lot better than last year, and we certainly don't believe that we're going to have the kind of good conditions weather-wise for the U.S. In the 2025 crop season that we had this past season, which doesn't mean it has to be a complete crop disaster, but anything that's low to mid 170s, Casey, down from 183, right now, the way as tight as the corn balance sheet looks like, that's just not going to work. That won't work. That you're going to be pressing low 1 billion bushel carryouts in the U.S. if we have a low to mid 170 corn yield, and that's really not too bad. We're not talking about that bad of a crop. That's just something a little bit below trend. So the point I'm trying to make about the corn market, we don't need a major crop problem in 2025 to create a much higher corn price. I'm going with 4.5 to 5 now because, we need to get there first, right? But I'm very, very comfortable that ultimately that's where we're going to find ourselves. And then whether we can punch much higher than 5 will really come down to what kind of weather do we actually have in the northern hemisphere. Will determine how much higher than 5 we get. But I'm very, very comfortable that a $4.5 to $5 market is achievable, and that, while not going to create multi-billionaires in the farming community, it's a profitable price, and it's a price that makes the ag economy considerably more robust than what was being talked about just a few months back when we were hearing about $2.90 corn, $3 corn, and on an extended farm dystopian depression going back to the 1985 farm aid concert to try to survive. I don't see that being the situation for the U.S. Ag economy. I actually think it's going to be considerably better. Not boom times like 21, 22, but certainly adequate as long as you take care of business and you make sure you sell those rallies. And we'll do our best to make those recommendations. And we made those. We gave some targets out in our report this week about what we think farmers need to be thinking about and looking for to get some further sales on the books. But overall, pretty optimistic that the demand-driven market in corn is going to continue for the foreseeable future, and that $4.5 to $5 area is a solid target for producers to be looking at and to be making some cash sales at. We're not too far away. We're 430-ish, in the 430s now, and one more bump up, and we're right in the zone. So
yep. Okay. Let's switch over and talk about cotton a little bit. Cotton was the one commodity there on the USDA report that was outside the range of what the market thought. We see some back and forth on cotton. I guess as you're looking at cotton right now, Shawn, with the stuff that we've seen, the hurricanes that have come through, didn't really overwhelmingly affect the cotton area. They kind of dodged and weaved those key areas. But I guess as you're looking at that, Shawn, as you look at cotton right now, assuming that we have a trade deal with China and those kind of things and everything move forward, need a farm bill. That's one of the biggest things being affected by the farm bill right now is cotton. But I guess as you're looking at cotton, your thoughts on cotton moving forward?
I think cotton is very simple. Cotton's job is to modulate the U.S. price relative to Chinese demand. I mean, they're the ones that buy most of our cotton. They are. So to the extent that the cotton market's been put into the penalty box because of concerns about a tariff trade war hurting U.S. exports to China, I understand that. But the way I look at it is this way. We just went through one of the most dystopian periods for the market's view of Chinese economy that we've ever seen. They have decided that they're going to reflate their economy. They decided to do it. They just announced last week a $1.4 trillion fiscal monetary stimulus that they're going to put in place. It's very different, though. The past stimuluses that they've put in place were all about capital assets, capital improvements, capacity increase, asset increases, real estate. This is completely different. They're actually, for the first time in their history, going to promote consumer demand. They're actually doing everything they can. They're handing money out to consumers so they can afford to buy homes. They're handing money to the consumers so they can go out and spend more. They're printing much more money. They're lowering interest rates. They're doing everything they can to boost the stock market. They're encouraging Chinese citizens to buy stocks so you can get the wealth effect of those that own stocks, and stocks go up. They spend more money. And we mean, this is what the U.S. model has been forever, right? Pump the stock market up and create the wealth effect. They've never done this before, and they've decided they're going to do this, and they're going to do it. And we're going to see better consumer demand from China. We're going to see a better economy. It doesn't mean rip-roaring, booming times of all times, but it means it's going to be a better outlook for the Chinese economy and the Chinese consumer in 2025 than it was in either 23 or 2024. And cotton is a direct beneficiary of increasing consumer demand in China, because if they're going to be more excited to buy things, they're going to buy more clothes, and cotton is going to be higher in demand. And China does not have a choice to not buy cotton from the United States, no matter what the trade policies are. So I'm very optimistic based upon what the Chinese actions they're taking and the commitment they're making to grow the consumer demand side of their economy, that cotton is going to be a beneficiary of increased demand. And we just need to be looking for a step up in Chinese imports of U.S. cotton. And if we see that, then I believe that we can see the cotton market make a move from where we are today, around the 70 cents area, give or take, that we've been kind of trading at for a long period of time, back up into that upper 70s to low 80-cent level, which is where I think is a more appropriate price level to be at, given what I think the Chinese economy is going to be, and what I think a realistic outlook for what a tariff policy would be. I think that's a more appropriate place for the cotton market to go to, and that is a price level that will pencil out for producers here in the United States. And I would be looking to make cash sales at that price level, and we suggested that exact point in our report this week.
Right on. Okay. One more thing I want to hit on before we close things down, just because of the effects of the last hurricane. What's the name of the last hurricane that came through Florida? Central Florida there?
What was it called?
I forget. Anyway,
I forget.
It'll come to me about the time that I hit stop, so that way I can go back in there and say. One of the biggest things I had there was I went right through, orange juice country, right? And a lot of orange groves there. I've read a lot of articles about, fruit that's fallen off the trees and a lot of damage to trees and those kind of things. As you look at the orange juice market right now, what are your thoughts there? And do you foresee a quote unquote shortage of orange juice that's going to cause a huge rally more than what we're seeing right now?
Well, we've been in a shortage now for several years. I mean, the market has been trading near 500 here, and the all-time high prior to this was 230. So,
right,
just remember we had an all-time greatest bull market in OJ history, never seen before in OJ ever before, and we're still in it. And yes, it's unfortunate. We were starting to claw our way back in increasing production here in Florida, and I wouldn't say we're going all the way back to where we were, but we're taking a step back, unfortunately. So it's like we took 2 steps forward, and we wanted to take 4 steps forward. So what we're doing now, we took 2 steps forward, we're taking 1 step back to go 3 steps forward. It's unfortunate, and it's created a recent surge here in the market. But the bigger issue to me is Brazil, because Brazil is the largest producer of orange juice, the largest exporter of orange juice. And here's an interesting fact. They've had trouble with citrus greening down in Brazil like we've had here. I think the last estimate from the Brazilian government is that 45% of the groves in Brazil have some form of citrus greening evidence that they have it, up from 35% a year ago, which means citrus greening is still rising. Meaning they haven't stopped it yet. So we don't know how much longer that will increase or not. But more importantly, what's interesting to me is this: even though they've had terrible weather, which has affected coffee, and we've been talking about the weather in Brazil, but it's obviously impacted the orange crop that produces the orange juice. But despite it all, their orange juice yields have been going up, meaning that their yield has been rising despite lower fruit and lower production. So they've been more efficient at getting more orange juice out of an orange than before. And that's meaning that they're because the prices are so high and because they're so profitable, they've been able to increase their yield per orange. And that's offset some of the citrus greening issue, and it's offset some of this weather issue. And if you look at the actual orange juice ending stocks, they just released them, I believe in August, year over year. They were actually up for the first time in like 4 years. Not a lot, but they were up despite all of it. What it says to me, Casey, is that supply, as low as it is starting to get the upper hand against crashing demand. And if we ever get a better orange crop in either Florida or in Brazil, if we ever have a good crop again, if it's ever possible, and of course we will, if we're already able to have supplies at these low levels be good enough against demand, any uptick and we have a massive oversupply. And so I think that we're on the verge of a potential top in the orange juice market. And I don't mean like just, a monthly, a couple of months, or I mean, a multi-year to a decade-long top could be in the making here over the next 6 months if we see any ability for better production in the next crop cycle against demand. It says, Tim, that we might be close to a tipping point here. So haven't seen that yet. Chart still looks good. We went over what the targets would be on a breakdown that would trigger or suggest that a final top might be in hand. So there's no action to be taken. There's nothing that says we're at the top yet. But fundamentally, our advanced work is telling us that we could be setting potentially a major top. And so if you're a producer of orange juice, you just need to keep in mind that the good times don't last forever, and eventually they end. And one might want to try to find a way to lock in this price level for as far out as you can, in whatever way that you're able to do that, to lock in a gain and a price level that you may not see again, potentially for 5 or 10 or even longer. I mean, it looks to me like we could be making that kind of a high here in orange juice over the next 6 months. So just something to kind of tuck in the back of your cap here. And I would argue the same thing for the cocoa market. Could be in a similar position where we could be putting in potentially a 5 or 10 year top over the next 6 months as supplies are starting to improve and starting to get the upper hand against demand. Still, once again, nothing conclusive technically yet on either market, but while we are wildly constructive on commodities overall, Casey, there are a few markets that are on opposite sides of the ledger. And orange juice and cocoa, certainly, if you're looking for markets that could have people are always looking for bullish markets and bearish markets. But if one is looking for the potential for strong decline markets to hedge long positions elsewhere. Cocoa and orange juice are markets to watch very, very closely, because when you get breakdowns from epic highs like we've seen in both these markets, history says that the declines are pretty wild, and so I'm watching those two markets very closely as counter hedges to some of the other markets that I'm feeling very, very good about. So,
okay. Lastly, a couple reports now. I've listened to you talk about coffee comes in there quite a bit, and you're looking at that. Global supply continues to slump as you look at just how things are being produced. And you talked a little bit about that today or yesterday in your report, where your flowering and those kind of things were issues with some of the plants down in Brazil because of the weather issues that they're having there. Talk a little bit about coffee and what you think there.
Okay. So coffee, in my position, potentially, no one knows for sure. No one can ever predict a supply scarcity trade for sure. But potentially, coffee's in a similar position to what OJ was and cocoa was a few years back. You have massive complacency. You have historic fundamental tightness, and in coffee, it's interesting. Since 2000, Casey, every commodity market has made all-time highs greater than we saw in the 1970s, except for two markets. The coffee market and the sugar market are the only two markets that have not made all-time highs since the year 2000. Doesn't mean they have to. But interesting that every other market has found a reason to blast off to all-time highs, and yet coffee and sugar have yet to do so. My feeling is the probabilities strongly favor that we are going to see a supply squeeze in the coffee market over the next 6 months. We've completely destocked the global supplies. Brazil's production this coming for the harvest of 2025, based upon another terrible hot, dry pattern going into flowering, the flowering not setting very well, a lack of vegetative growth from the prior year because of the drought, pretty much sets the potential that Brazil cannot see any ability to produce a good crop in the following in 2025 harvest. And everything that I see says that we're likely to trigger some kind of a supply squeeze. The all-time highs in coffee, if I remember correctly, I think are 350 that we set in 1977, if you can believe how long ago that was. I believe that the high since 2000 was 331 that we set in 2011. And I think that coffee, of all the markets I look at, the only market that I see that has a legitimate shot at a true supply scarcity trade, right now at this moment in time, is the coffee market. What I'd be looking for, and what I showed in my report this week, typically what tells you that a supply squeeze is taking place, just as a kind of backing away for a second, commercial operators have to report their positions to the CFTC every Friday from the prior Tuesday. Typically, commercials buy when things are cheap and they sell when things are expensive. I mean, that makes logical sense, right? They're in the long-term business of buying low and selling high. However, every once in a long while, they get caught being heavily short when the market gets into a supply crunch, and they are forced to buy it back in to a rising market. When your natural seller becomes a buyer is when you get these parabolic rises, these gapping ups, these runaway advances. We saw this in cocoa, saw this in orange juice, saw this in oats a few years back, saw it in lumber a few years back. And we have not seen that yet. But what we're looking for is signs that that if the coffee market starts to rise and we're seeing commercials buying back their shorts and the natural seller becomes a buyer, you enter at what's called a seller's vacuum. And that would be the indication that the coffee market is about to embark on one of these supply squeeze runaway advances to the upside. And And so right now, the coffee market's been stuck in this 240 to 260 trading range as the market is, trying to figure out. We've had some rains, but the flowering and trying to get out. What I'm looking for is a break above the 260 area on a weekly closing basis the March contract. And I would want to see those commercials on the CFTC report buying back in. If we get those two triggers, then that would increase the probabilities that coffee might finally join other commodities in making all-time highs and could do something to the upside, akin to what we've seen in orange juice and cocoa. Right now, no evidence yet. Haven't seen it yet. We're not getting that yet. But I believe that the prospects from my work suggest that the probabilities of that type of a move is possible here if we get the right set of variables, and we'll be monitoring that very, very closely. And obviously, if you're a physical buyer of coffee, if you're a roaster, in my opinion, it's completely irresponsible to not be protecting your upside price risks in case one of these types of moves takes place in coffee that took place in other markets in the past. To me, as a risk manager on the trading desk of a roaster, it would be completely irresponsible to not protect your upside price risks of your physical supplies and needs. Because in a situation like this, Casey, what happens is there's going to be defaults, meaning that that there's going to be cash sales that aren't delivered on. They're going to default on these cash contracts. So supplies that these buyers thought they have, and now they don't have, and now they have to try to go buy it in the actual market when there's a supply squeeze. This is how these markets build on themselves. If any roaster listens to your show, it's irresponsible to not be protecting upside price risks in case it happens. Worst case is you lose a little money on your risk mitigation strategy. Best case is if we get a $3 or $4 or $5 market, you're not going to be hurting as a company with your balance sheet because you'll have factored it in to your overall cost structure. And that's what the whole game is, right? The whole game is in this business of supply and demand, of buyers and sellers in the physical market, of businesses on both sides of the aisle. It's not about guaranteeing an outcome. It's not about saying, I know this or know that. It's about understanding where the risks are, where the probabilities are lying, and where you could get hurt the most. Right now, a roaster does not get hurt if coffee goes from 250 to 2. He wins. He gets hurt if it goes from $2.50 to 5. He hurts big time. You have to manage the risk that hurts you the most if it looks like there's a possibility, even if it's only 20 or 30% to the upside. And that's where I feel we are in the coffee market. So very, very interesting market to watch in the next 3 to 6 months to see if we actually get a supply squeeze to be triggered here or not. But definitely could be one of the big stories for 2025 that people will, that the media will be talking about, is potentially what happens here in the coffee market. We'll see.
Right on. Okay. Shawn, good stuff as usual. Covered a lot of ground today. If folks want to reach out and get more information about what you're doing at Hackett Financial, what's the best way to do that? Our
website is Hackett, Hackett advisors.com. They can sign up for a sample report if they want on there. That we put some stuff out on our Twitter page at Faradex11. We also do the same thing on our LinkedIn page to give people ideas of how our cycle statistics and correlations are viewing various ag markets and what we think might be happening, so that those watching and listening to your show may get some value out of it.
Right on. Appreciate you, Shawn. We'll catch you again next time, man.
Sounds good, Casey. Always a blast. Thank you so much for the invitation. So
you're always welcome, sir. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, X. Gotta stop saying Twitter, X, and Instagram at Moving Iron LLC. Go to LinkedIn at Moving Iron Podcast. Check out the video version over on the YouTube channel, which is the Moving Iron Podcast YouTube channel. And you can also find everything Moving Iron related at movingironllc.com. Go to TikTok at Moving Iron Podcast, and you can find us there. So with that, I'm Casey Seymour, Sean Hackett. Let's go smart, folks. Out. Iron Podcast is brought to you by these great sponsors. Are you looking to value your equipment more accurately, target the right buyers and close more deals, reach your ideal customer? Then look no further. Fusable isn't just about ag data, it's about action. Our best-in-class solution empowers you to value your equipment accurately, make informed decisions, and find the perfect prospects. Ignite your dealership's growth at fusable.com/movingiron-podcast. Out in the field, every decision counts. You wouldn't plant without testing your soil, so why would you prospect blind? Introducing EDA, your one-stop shop for ag equipment intel. EDA goes beyond specs and prices. You get deep dive data on every piece of equipment like UCC filings that help track ownership changes and uncover potential sales leads. D&B firmographics, which help you understand the financial health and buying power of potential customers. Market trends that help you stay ahead of the curve, and insights on equipment demands and pricings. With EDA, you're not just looking at data, you're seeing opportunity. Find the right buyer, sell smarter, and build lasting relationships. Visit edadata.com for your free demo and unlock the power of knowledge. For over 80 years, Iron Solutions has been your go-to data source for ag dealers, lenders, and manufacturers. Get powerful appraisal and value forecasting tools that fuel profitable decisions anytime, anywhere. Get your free demo at ironsolutions.com. Iron Solutions, confidence in every click. Today, there are many ways to finance ag equipment, but nobody delivers simple, fast, or flexible financing like AgDirect. Learn more about your options to buy, lease, and refinance equipment at agdirect.com. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours. This podcast is proudly provided by Axon, helping dealers move more iron for the past 100 years. Find out more at axontire.com. Move more iron with Axon.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here.